Good afternoon, everyone, and thank you for joining us on today's Wednesday WISE webinar. My name is Sydney Konahia, and I'm the manager of membership with IFA, and we have a great 60 minutes lined up for you this afternoon. Before we begin, I just wanted to touch on a couple things. Today's webinar will be recorded, and the recording, along with the slide deck, will be made available later this evening on community.franchise.org. And if you have any questions for today's speakers, just feel free to drop them in the chat or the questions box, and they will be answered towards the end of the session. Today's topic is how to secure private equity funds for your franchise, and it's brought to us by Thrive. Here to provide today's session are Matthew Gorgio, Head of Franchising for Thrive, John Goldberg, Managing Director for Lazard, and Nick Friedman, President and Co-founder of College Hunks Hauling Junk. Thank you all for joining us today, and thank you again to Thrive for sponsoring today's Wednesday WISE webinar. And I will now go ahead and turn things over to our speakers to get things started.
Thank you, Cindy. I appreciate you guys letting us sponsor. It's a big couple of weeks for the IFA now. You've got this webinar, and then we've got the annual conference coming up in Vegas. So we're really excited. My whole team's going to be there, and looking forward to sponsoring that and getting out there and seeing a lot of franchise people. But today, we're really excited about this webinar because I think we've got, one, a really good topic to talk about. And a lot of people are interested. I see we've got a good bit of attendees today. And then we've got a great panel, John Goldberg, Nick Friedman. And, we've prepared ahead of time some questions because we want the people that are attending to obviously get some actionable items to take back to their brand, or to at least be able to ask some questions at the end to get those answered. And I think, with John and Nick here, we should be able to cover a lot of ground. When you're looking around the franchise space, one of the reasons we picked this topic, because I know every time I open up LinkedIn or, look on franchising.com or franchise, or the various different publications, there's always, it seems like every week now, almost, there's some type of transaction happening. There's some kind of private equity headline working with various brands. And if you're new to the industry, or maybe you've got an emerging brand or whatnot, and you have aspirations to maybe partner with a private equity firm or sell to a private equity firm down the road, we have some content today that I think could really educate you. So the agenda, as we go through this, we're going to start out with some of the basics, just private equity basics, cover kind of what is private equity, why are PE firms attracted to franchising, like, what is it about this space? What is it about this business model that they really like? Then we'll go into the types of deals, because there's a variety of different ways that you can partner with the various private equity firms. And we've got a good kind of breakdown of how it works with that. And then we'll go into the items that private equity firms are looking for in a brand, specifically, from a unit economic standpoint, some of the other items that they may be looking for. Next will be red flags. Like, what are the red flags that would absolutely make a private equity firm kind of apprehensive to work with you. Then lastly, we'll get into the valuation of your brand, like how much you're going to sell the thing for, or what is your brand valued at, like how do you arrive at that, and how does it vary by types of industry. And then the very last thing will just be the process, so that one, how to start, two, what to expect as you go through it, and then we'll wrap up with some Q&A at the end. But joining me today is Nick Friedman and John Goldberg. And Nick, why don't you, you've got a pretty good background on here, a couple bullet points. You appeared on Shark Tank. You founded the company in 2005, College Hunks Hauling Junk. You've been through a transaction, college basketball player. Not a very formal readout of your bio, but just tell them who you are and your experience, and so that they know who the heck's on the screen with us today.
Yeah, appreciate it. Thanks for having me, and welcome everybody that's attending. So give you a quick background on our business and sort of why I guess I was asked to be on this panel. Started our company unofficially when we were in college. It was my buddy's mom who had a beat up cargo van, and she let us borrow it. And she said to us, "Hey, you guys could be like college hunks who haul junk." And we thought it was a catchy way to make the phone ring. So we started the business officially after college, and I always tell the story about how we had the 800 number on the back of the truck routed to our cell phone, and so people would call to complain about erratic driving, and I'd be the one answering the phone, pretending like I wasn't, the one driving. Probably fired ourselves 3 or 4 times that first summer, and eventually we learned how to work on the business, not just in the business. We learned about the wonderful world of franchising. At the time, we kind of maybe thought it was a glamorized way to grow, but it was a very steep learning curve. I like to call it a 15-year overnight success since we began franchising in '08. We today, as you mentioned, have over 200 franchisees around the country. We just do roughly $300 million in annual revenue last year, and we did a transaction, what we call it a non-controller minority transaction with a private equity group about 2 years ago. And as the founder, which you'll get to hear more about as we get through the presentation, it was an opportunity that my business partner and I saw as a way to, take some chips off the table. We also used the word de-risking a little bit because we had, almost 100% of our net worth, wrapped up into, the business of College Hunks, the franchise of College Hunks. And, also an opportunity to align a partner for a future transaction as well, so sort of a sophisticated financial partner to position us for the future transaction. So it was a long journey to get there, and so I'm sure our audience may be at different phases of their journey in franchising. So happy to speak to each one of those as we get into the presentation. But grateful to be here. And John, who's here on the webinar, is his firm actually represented us during our private equity transaction 2 years ago. So thanks for having me.
Yeah, no, I appreciate you giving us the update. I think you'll provide a unique, you'll be able to talk to it as the franchisor, obviously, that went through that. I know we've got a lot of franchisors that are logged in here, and getting your feedback will be extremely helpful. But John, you work for a very unique company, kind of, you've got a really cool background, a lot of experience in this space. Why don't you tell everybody what you do and kind of how you do it, and a little bit about your background?
Yeah, thanks, Matt. And to the IFA, just really appreciate the opportunity to talk about what we do and share this panel with Nick and with you, Matt. So I'm John Goldesich. I work for a firm called Lazard. Lazard is an investment bank. It's been around for about 175 years and has been a part of transactions for some of the best companies in consumer, industrials, healthcare, technology, infrastructure, just across the board. But people often ask, what is an investment bank? An investment bank is really a financial advisor that helps put transactions together. We advise companies on raising capital, on mergers and acquisitions. We advise private equity groups. And we also advise companies just if they're looking to raise capital for non-dilutive growth, for debt or other structured products. So I'm not a private equity investor, but it's really my job to represent franchisors and other operators to get the best deal possible when they choose to transact with a private equity group or with a strategic acquirer, or really whatever their business objectives are, just along their ownership continuum. So I've been in the business for over 16 years. I've been with Lazard for not quite a year yet. Prior to that, I was at a consumer-focused boutique for the last 16 years, where I ran our multi-unit and consumer practice and franchising practice. You see some of the deals that I've been a part of. Obviously, College Hunks is one of the deals that I'm most proud of in my career. My Salon Suite, Camp Bow Wow, Pure Bar Fitness, Velvet Taco, Nuke's Eatery, just to name a few in terms of some of the franchisors that I've been able to work with along my career.
Yeah, thanks for the update, John. And you obviously, if there's someone on the call and you want to meet someone in the franchise space, John's a good contact to have. Has been working in franchising for a while and knows a lot of the great people that are working in the space. So appreciate the update on both your backgrounds. And so let's just kind of get into the meat of it here. And John, I know this is a pretty vague question, right? But if you could just maybe, for some of the people that maybe don't quite know the definition of a private equity firm or If someone was to ask you, what is a private equity firm, what would be your response? And can you just explain maybe that industry really quickly?
Yeah, happy to. So I'll give you kind of the Webster's definition, but then I'll kind of expand upon it. Kind of the dictionary definition of private equity or of a private equity group is a firm that invests money on behalf of investors. And they look at other companies, private companies. That's why it's called private equity. And they invest, and they either acquire or take a position in that company in hopes that they can generate a return for their investors. The people doing the investing at the firm are typically finance professionals, operators, former consultants. They're considered the general partner, and then it's usually pension funds, endowments, and high net worth individuals who are considered limited partners within private equity, who are investing behind those general partners to take positions in companies. So that's kind of the long dictionary definition. But what I would tell you is that, and we'll get into this in subsequent slides, but private equity is much bigger than kind of one thing. I know when we talk in forums like this or on panels, people say, private equity likes this or private equity likes that. And to a certain extent, that can be the case, but private equity encompasses a lot of different, different strategies. Some people are growth investors. Some people invest in businesses that are not doing very well. They're turnaround investors. Some like to acquire a majority position in a business. Some like to acquire a non-control position in the business. Some write massive equity checks. I mean, billion-dollar equity checks and are looking at investing in big businesses. Some write small equity checks and look to invest in small businesses. And so there's a really wide spectrum that encompasses private equity, and that's one of the things that we want to talk about today as well.
Yeah, and Nick, just a quick question for you. When you launched the brand, and obviously you launched in 2005, you were on Shark Tank in 2009, so I would think you had to do a little investment research, right? You were out looking for capital. If you think of like an emerging franchisor that's on the call here that maybe has a low understanding of kind of how this works, like in your own experience, when did you first like really start looking into private equity or really understand it kind of in your journey? Was it early on, or how did you learn about it?
So it was definitely an evolution of learning, and opportunities like this webinar, were very valuable. Any resources that the IFA puts forth, whether it's a webinar like this or the conference coming up next week, in 2 weeks, are extremely valuable. So we never really thought we would bring in outside capital into our business. We had some bank loans for our trucks, but we really bootstrapped our business. As I described earlier, we were the ones driving the truck and answering the phone until we could afford to hire an employee and could afford to get a second truck. And so when we got into franchising, franchising in and of itself is somewhat like bringing in outside capital, because you're selling a franchise unit to an outside party. They're writing the franchise fee check, and then that franchise fee in the early stages of a franchisor really isn't a profit center. It's used to help build out the infrastructure and the systems and develop the platform for the business to grow. So we were hyper focused on franchising, and again, never really considered raising outside capital. When we went on Shark Tank, we were actually weren't really sure if we were going to do a deal or not. It was the very first episode of the very first season, so we were kind of responding to an ad that said, "Hey, looking for entrepreneurs to pitch a business idea for a TV show that might want to invest." So we had an offer from Robert Herjavec at the time, and he offered us $250,000 for 10% of our business. And at the time, it was probably a fair offer from him because our business had 5 or 6 franchisees, and we weren't significantly profitable yet. But we couldn't fathom the idea of giving up 10% of our business that we had already worked 5 years to essentially build and get off the ground to start franchising. So we actually turned down the offer. We didn't realize that those sharks were all going to become, TV celebrities and be on television for 10 plus seasons. But nevertheless, that was kind of our decision at that time. And so we never really contemplated bringing in outside capital again until, fast forward a little over 10 years later, when our business was significantly more profitable. And coming out of COVID, when we had that moment during COVID where it was like, wow, a black swan event could come and knock everything out, and everything we've worked for the past decade could go away. We want to de-risk. It was really our motivation for bringing in outside capital. So we probably could have grown faster, maybe shortened the learning curve a little bit by having an outside investor sooner, but we would have been giving up equity in our business a lot earlier, and our business wasn't as valuable 5-10 years ago as it is today, or as it was 2 years ago. So for us, we kind of steered clear. We had kind of heard some horror stories about, bringing on outside capital, some of which may be true, but we just, because of those negative things we had heard, we weren't as inquisitive in those early days. But I did hear, when we were still an emerging brand, I heard a panel at the IFA where they said, you need at least $1 million or more to be able to go from, 0 franchises to 100 plus franchises, when really you're at that critical mass point where the royalty stream is typically self-sustaining the business and so forth. And so we really were, like I said, bootstrapped hand to mouth. We leveraged our corporate store profitability to help fund our business. Any profits that we generated within the company during those emerging days, we kind of reinvested into our business. So we were sort of our own investors, if you will, by reinvesting ourselves into the company as opposed to bringing in outside capital during those early days. And so we ultimately decided it was time to bring in some outside capital, which is what we did 2 years ago.
No, it's really interesting. You turned down a shark.
Yeah, we were one of the first ones to do that, I think. And again, the show hadn't become that popular yet on television, so we didn't even know that it was like an actual tactic that some of the entrepreneurs on the show do to just generate the publicity. But it was actually ended up being good TV exposure for us. It reruns every now and again on CNBC, so we like to say it's the gift that keeps on giving. But yeah, it was our first experience, sort of talking to investors, sort of trying to pitch and come up with a valuation for our business, and trying to justify, why somebody should invest in at the time was more of just our vision, because it wasn't a hugely established business, like it is today.
No, that's great. So, we'd already listed some bullet points here on this next slide where, we were talking about why are franchise companies in such high demand for these PE firms, and John had shared some ideas around it, high margin cash flow. But John, can you just go into this specifically, what it is about the franchise model and why some of the PE firms that you've worked with really like the space, and obviously we've got some listed here, but could you just talk to this slide?
Yeah, absolutely. And having advised franchisors for for almost 2 decades, I feel like I'm a bit of a historian sometimes, or kind of play a historian, because I tell the story. One of the first franchising deals that I did, I sold a franchisor called Mo Southwest Grill at my prior firm to Rourke Capital, back when Rourke was just a tiny upstart private equity firm. I don't even think they'd raised their first fund at that point, or they were on first fund, their first fund. But we only took that deal to a handful of private equity groups because at the time, 16, 17 years ago, there weren't that many private equity groups that were comfortable with franchising, and what the franchising model was, especially in kind of the middle market. And so for almost a decade, it was a bit of a secret. There were some really kind of early movers in the franchising space within private equity. The Riverside Group's a great example. They've got a great track record. Levine Leichman, others who were early movers in the space. And it's like the secret's out. The cat's out of the bag. The secret's out. You're hard pressed to find a private equity group that looks at either consumer services or just you know, the services or multi-unit space in general, that's not interested or that doesn't own a franchisor. And it's for, you know, many reasons, but several of the reasons and the highlights that you have on the slide right now. I mean, it's you know, once you're able to get to royalty self-sufficiency, you have a very high cash flow margin business. You know, your royalty stream, you know, for the first several years as you're growing, you know, is going into, you know, investing in technology and infrastructure and support and training and everything that you need to make sure that you have you know, sustainable, happy, healthy franchisees. But once you kind of hit an inflection point within your franchisor growth, you know, you have really, really strong margins. I mean, it's not uncommon for a franchisor of scale to have 75% EBITDA margin. So, you know, for every dollar that they're bringing in royalties, 75 cents is profit. And those are the types of margins that you see in you know, in technology businesses and in SaaS businesses, you know, for instance. And so you can do a lot with that from a financial perspective. You can lever it, you can securitize it, you can add on additional you know, royalty generating franchisors. You've seen a lot of platform formation over the last several years, multi-brand kind of concept holding companies. But you know, so from an investor perspective, you have high cash flow margins. You've kind of spread out your risk over many different operators, being your franchisees. And you have a lot of optionality with what you can do with that. You can grow organically, you can grow inorganically, you can raise debt, you can you know, you can make acquisitions of other franchisors. You know, like I mentioned, Roark Capital. I mean, they're a great example. They buy really high cash flow margin businesses, and they don't really sell many of them. I mean, they, you know, kind of the way that a lot of private equity groups generate their returns is they invest in a business, and then 4 or 5 years later, they sell that position in a business. And in a group like Roark, they'll just hold on to something and just, you know, recap the business with debt and in a prudent level, and use dividends to generate returns for their investors. And so it just gives the investor a lot of different optionality that you know, that private equity groups find attractive.
No, that's great, and I think that goes into we wanted to talk a little bit about the different alternatives, right? I mean, the different types of deals that you put together, whether it's non-controlled, Nick had mentioned that before, versus controlled. So I think we'll have both of you kind of weigh in on this, because there's certain motivations right behind it of what happens after you start partnering with that firm. But could you, for the audience here, or for the people that watch the recording, when we're talking about non-controlled versus controlled, can you go into that a little bit, and then the different types of deals and maybe the motivations behind those, right, with the franchisor and their leadership team and whatnot? So I don't know if you can just speak to that.
Yeah, happy to. I'll start, and then Nick, you know, you weigh in terms of your perspectives, because you know, you've lived this with your investor and your transaction. You know, what I would say is that when I'm working with founders and entrepreneurs and franchisors, the first thing that I ask them is, what are your objectives? You know, what do you want to do? Do you want to grow this on your own? Do you want to take chips off the table? Do you want to be the leader of this business for the next 5, 10, 15 years? Do you want to sell to a strategic and sell 100% and maximize value today? Do you want to look at, you know, optionality for upside or a second or a third bite at the apple, you know, down the road and in the future? And everybody's motivations are different. You know, everybody has different you know, financial objectives, family objectives, career objectives, objectives for where they want to spend their time. And you know, if you own a business, that is what is going to drive, you know, what transaction could potentially be attractive to you. And so there's really not a one size fits all approach. And as an advisor coming in and working with businesses, that's really one of the things that we help most with, is just helping business owners, founders, and entrepreneurs figure out what strategic alternative or transaction alternative is right for them based on their objectives. And so, what you see on the slide here is really kind of a span or a continuum of transaction objectives from not giving up any equity or any control in your business to giving up full control and selling 100% of your business. And so, you could raise private debt, and there are private debt funds that is technically under the guise of private equity. It's not like going to Bank of America or Wells Fargo. It's actually going to a private credit fund who will invest at a higher rate than a Wells Fargo or a Bank of America, and play kind of a value-added role in your business to a certain extent. You have growth equity investors who are typically going to invest in a non-control position. There are these things called royalty funds out there that will invest in royalties generator, generating franchisors of scale. You can have strategic investments from other franchisors, and then you can do a change of control. You can sell 51% or more of your business to a private equity group. Or you could sell 100% of your business to a private equity group that has a larger, we call them quasi-strategics, that has an existing investment in a franchisor, and that franchisor then acquires your franchisor. And so there's a lot of different ways that you can look at it. If a private equity group is investing in your business, to back you and to grow you, they typically want you to have skin in the game. They don't want to acquire 100% of your business. They want to make sure that there is future financial alignment with both the founder or the management team and the private equity group that's making the investment. And so there's a lot of different factors that go into it.
Yeah, Nick, when you guys were going through this and you were, probably it sounded like you worked with John and you were thinking of, your objectives behind it. How did you go through that? What were your thought processes? And then I think you went the non-controlled route. Can you tell everybody kind of why you did that?
Yeah. So in our situation, as we were thinking about our objectives, our goal was to take some money out of the business, put it in our own personal account, and invest it outside of college hunks, because as I mentioned, college hunks consisted of probably close to 95% of my net worth at the time. So I didn't want that extreme exposure. I wanted to de-risk a little bit more. I just turned 40. I just had 4 kids. So I wanted to, again, sort of de-risk my business holdings a little bit. But I wasn't prepared. We weren't prepared to sell the whole company because I got a lot of runway left. I got a lot of fire left in my belly, and I felt like we could grow the business in a meaningful way in the foreseeable future. And the business was cash flowing nicely and continued to improve cash flow every year. So I didn't want to sort of kill the golden goose, so to speak, that was laying the golden eggs, but maybe harvest some of the eggs and then just let it keep laying some more. So, or sell a portion of the goose, but don't kill it. And so that was kind of my motivation and my business partner's motivation. And so that directed us more towards what we called the non-control route. I always thought of it as sort of like majority or minority. So selling the majority of the company, over 51% of the business, or selling minority, less than 50% of the business. And so because those were our objectives, was to sell a minority stake or a non-control stake in the company, that's where we sort of focused our energy and effort. Like I said, we weren't ready to sell the whole business. We thought and continue to think we can grow it to be a lot bigger than it was 2 years ago, and that it will be 5 years from now. And so and then the other thing, just from a alternative perspective, I had no alternative of what I was going to put a much bigger chunk of money into if I didn't have the business any longer. And I didn't want to become complacent. I think complacency can lead to bad decisions and or bad results or bad outcomes. So I wanted to still have a meaningful role with the future of the business that we had started, over 15 years earlier, and not give up, all the upside. So that was sort of what landed on what type of deal we were going to do. And then from there, it just the key for us was focusing on, okay, then who is the ideal partner for us to partner with, and what are the terms, around the offer that they would ultimately make, valuation, structure, and other things. And I had to really become a student of kind of capital raising and business structures and some of the things that are being talked about here, because I had never really contemplated, and it wasn't something I studied previously. So I talked to a lot of mentors and, read a lot of articles, and obviously John and his team was helpful in helping us kind of understand the nuances of the different type of pathways that we might consider. We talked to some strategics as well to see if it made sense for us to sell the whole business or to sell a portion of the business, but ultimately, as we've talked about, we landed with a financial partner that bought into a non-control minority stake in our business.
Well, no, it's interesting. And it's interesting that there's, obviously various options based on where you are kind of in your life and where you are with the business. So for those that are watching this, and granted, they may be back in your position, Nick, a few years ago, where you're an emerging brand, maybe you have aspirations to one day, grow a great franchise brand like you have. But we wanted to get into kind of what specifically private equity firms look for in franchising. And I know, John, you had mentioned it's different, maybe by the organization that you're working with, but maybe some of the what I call Mount Rushmore things, or the really core things as they're looking at franchise brands as far as number of units, size, the profitability of the franchise base, right, the unit economics. We listed the history, legal history, control. But John, when you're representing a brand or you're talking to a private equity firm, give kind of some of the emerging brands or just any franchisor watching this, the really big rocks and the things that they absolutely have to have when they go into a transaction like this.
Yeah, absolutely. Look, again, there's not a one size fits all approach in terms of size, in terms of number of units, things of that nature. It's going to depend on what sector you're in, honestly. So if you're in food service, it's going to be different than if you're in residential services. It's going to be different if you're in pet care than if you're in in fitness. Like there's so many. The great thing about franchising is that it's a business model that applies to a lot of different subsectors, both within the consumer services world and even industrial and commercial services. And so all of those kind of have different financial characteristics and valuation considerations and things of that nature. For instance, if you are if a private equity is looking at investing in a franchisor on a standalone basis, then they want to see that there's profitability or a path to profitability, and different private equity groups are going to have different hurdles in terms of where they want that profitability to be. Some will invest in franchisors that have $1 million in EBITDA. Some will say, we don't want to invest in franchisors unless they have close to $10 million in EBITDA. So there's a big, there's a lot of different parameters, and I think working with an advisor, like myself or others, they're going to be able to kind of interpret that for you and kind of read the tea leaves, because it's our job to kind of know where these investors are looking for pockets of opportunity. I think it's also going to be different if a strategic, a larger private equity backed franchisor, think about like a Neighborly or an Authority Brands or Propelled Brands or Unleashed or one of those kind of multi-brand holding companies. If they're looking at your business, they're not going to have the same size parameters as a private equity group who would be potentially investing on a one-off kind of platform basis. They're looking to acquire brands that are strategic for them, that kind of fit, fill a white space within their offering. And so, if you're in the right sector at the right time, you could potentially be, subscale for a traditional private equity group, but be perfect for a strategic acquirer who's looking to make a play in your sector. But I would say above all else, and kind of the key thing, and one of the things that really set Nick and College Hunks apart is whoever you're talking to, whether it's a private equity group or a strategic or a control investor, a non-control investor, having really high quality, credible data around your franchise system is going to be really, really important. And so I always encourage franchisors to, have a standard chart of accounts for their franchisees. I encourage franchisors to require their franchisees to submit, to submit P&Ls that are on the same chart of account. Nick and his team actually have, provide bookkeeping services for a vast majority of their franchisees, and so we had a high level of visibility into franchisee level performance. And that's going to be really, really important, because what you're ultimately trying to substantiate for an investor or an acquirer is, are your franchisees happy? Are they healthy? Are they making money? Are they growing? And are they going to continue to grow within your system? And if you can prove that out with really credible data, then you can get credit for a significantly higher EBITDA than what your accountant tells you have today. You may have $1 million in EBITDA, when you look at your P&L and you look at net income and add back depreciation and amortization and taxes. But an advisor like myself is going to look at you, and we're going to look at you on a run rate basis, and we're going to look at your franchisees that have not fully ramped to maturity, but have been open or are about to open, and we're going to create what's called a run rate adjustment. And if we have really credible data, if you're $1 million EBITDA franchisor, we may be able to show that you're a $5 million EBITDA franchisor, and there are private equity groups that would be able to underwrite that based on that credible data and value you based on that.
And Nick, when you, obviously John's giving you some props here on your brand, but when you guys started thinking about that black swan event and prepping your brand, for the non-controlled kind of transaction, was College Hunks just ready to go? Did you have all your ducks in a row? You mentioned the bookkeeping things that you did for your franchisees, but were there certain things you had to do to get ready for that? Had you been planning that for a while? Like, what are maybe 2 or 3 things that a franchisor, if you could just piggyback off what John was saying, should do right now, even if they're not planning a sale, that would get them ready for it, maybe down the road when they do become interested in it?
Yeah, so I think focusing on unit level economics is a drumbeat that we hear time and time again in franchising, and I think that can't be emphasized, or can't be overemphasized. I mean, it's so critical that your franchisees have a level of success that validates, quite frankly, the sustainability of the business model and of the brand. And so that doesn't happen overnight. That happens over time. And it was an evolution for us. Our early franchisees struggled, and we were trying to figure out the model, and we were continuing to sort of build the plane in flight a little bit. But the other thing that I think was really critical to have in place for us is a very financially savvy member of our leadership team that could help produce the reporting and the metrics and the sort of charts that we could then hand over to a more sophisticated team of financial engineers with John's firm to then be able to present that to the prospective investors. I think one of the horror stories that I used to hear about when people would talk about, bringing in a private equity investor is that the founder, who's, usually like myself, very, creative, likes to, think of big picture ideas, doesn't like to get bogged down in spreadsheets, the founder then has to, if the founder doesn't have somebody to do those internally, has to start, cranking out board reports and spreadsheets and all these things that feels like hard, tedious work. And that isn't something that I enjoy or wouldn't have enjoyed doing as a founder entrepreneur. But because we had somebody in our team that was good at that and continues to be good at those transparency of metrics, that made that critical piece of the transaction off of my plate, and so it didn't feel like a burden to me, both going through the transaction and then post transaction, because the financial partner wants to see metrics every month, wants to see the P&L reports, wants to be on the board call and understand how the business is performing financially. But I can talk more about the big picture strategy, the vision, the culture, the stuff that I enjoy doing and I think I'm good at, versus the stuff that bogs me down, and I think bogs a lot of founder owners down in the numbers. So I think those two things were helpful for us. Had we tried to sell a part of our business earlier in our evolution, not only would our business not have been worth as much as it was when we did our transaction, but we wouldn't have had the systems or infrastructure in place to, I think, appease the outside investors that like we do now. And so, I think those two things were valuable for us to put in place before we contemplated bringing on outside capital.
Yeah, and thanks for that, Nick. That's really interesting. And John, just for the people listening, we do hear there's a lot of panels about unit economics, and just about every franchise panel I've ever seen at a conference or whatever, people are bringing up unit economics. But the standard charts of accounts that you had mentioned in passing earlier on this slide, can you just in like 30 seconds explain what that is for the franchisors here? I mean, when you look at unit economics for franchisees, my wife's Range Rover is in the business, even though she's not an employee. Can you just explain like how franchisors manage that and what that is?
Yeah, so like when you think about franchisee P&Ls, it's basically everybody being on the same chart of accounts, the same buckets within a QuickBooks file for all their expenses and other buckets with that comprise of a profit and loss statement. And so the way I think about it is you want an outside investor or an acquirer to be able to compare franchisee performance on an apples to apples basis. And so you don't want one franchisee to be thinking about marketing expense in one way and treating it one way, and then another one, thinking about marketing expense another way. And look, it's fine that franchisees, can run personal expenses through their business, but you just wanted to make sure that it's categorized properly so you know where those are, as opposed to, being in, you wanted to be in one place in the P&L as opposed to 16 different places in the P&L. And so that's really what it means, is just having a standardized way to be able to compare franchisee performance across a big system on an apples to apples basis.
No, appreciate it. I just wanted to make sure we covered that. And just for time, because we want to leave a couple minutes for questions here, I'm going to skip the red flags portion. We can maybe address that in the Q&A. But this piece, I did want us to spend a couple of minutes here because I've heard, obviously, this is when the claws come out or stuff gets real. But when you're looking at the valuation of your brand, what you're going to sell it for, I want to hear from both of you, and especially Nick, in your experience of going through this with a private equity firm. But John, specifically, kind of just start us out with, like, how do you arrive at what your company is valued at, right? And when specifically working with a private equity firm, what are their expectations? And does it vary, within franchising, whether it's a home service brand, a pet brand, a fitness brand? But can you just kind of give us a couple ideas here on how do you arrive at the business valuation?
Yeah, absolutely. Look, obviously this is a topic where people have can have some anxiety or really kind of not really kind of fully understand how firms arrive to a valuation. And what I'd say is different firms arrive to different valuations differently, but the main thing, kind of, if you had to boil it down to the most simplistic way to think about valuation, it is, what is an investor's confidence in the future cash flows of this business? And so when you think about, yes, they're valuing you today, but they're thinking about how is this business going to look 5 years from now or 7 years from now. And so if they have a high degree of confidence in your business's ability to grow and ability to continue to add new franchisees, your franchisees are going to continue to grow. They're going to be continuing to progress along their development schedule from a fran dev perspective. That's really where investors get a high degree of confidence and excitement in businesses and are able to value them, candidly more aggressively. And the higher the growth rate, the bigger that your business could potentially be, and the higher degree of confidence that a private equity group has that your business is going to be bigger in the future, the more they can pay for it today. And so, key factors to that are going to be, what's your cash flow today? What does your 5-year projection model look like? And advisors like myself can help you put that together, or along with your team if you don't have a 5-year projection. We'd encourage you to start thinking about that today, and always kind of building your business and making decisions based on that 5-year projection. But then, a firm is also going to do what's called a discounted cash flow model, which means they're going to look at what your business looks like in 5 years, and what a terminal value or what a potential exit value of your business can be, and then discount that back to present day, using a bunch of complex spreadsheet math, and that kind of arrives at a same that kind of serves as the basis of the type of EBITDA multiple that a investor can pay today. And so growth is a big factor. Your ability to have a really strong, confident view in what the future of your business looks like is going to be important. And then kind of the last bullet point around just the type of business, like what kind of sector headwinds or tailwinds are you facing at the moment? Certain sectors are going to be are going to have higher growth rates attached to them, or there's going to be more scarcity value in the market where an investor wants to acquire something, but there isn't really anything out there. And so if you kind of are able to fill that void, you can exploit that. But then also, one of the key factors to valuation is going to be competition, and being able to run a process where you talk to multiple parties and you create, somewhat of a competitive process where multiple parties are looking at your business at the same time, and that allows you to Nick's point, to be able to spend time with multiple groups, multiple personalities. Pick who is going to have the right value, the valuation that works for you, the terms that work for you, but also is the right fit, the right cultural fit, the right the right personality fit, who you want to align yourself with from a business perspective for the next several years, because you're truly bringing on a new partner. And so and oftentimes that could be the person who, or the group that pays the most, but in some cases it could be the person or the group that can provide the most value to your business and ensure that those next 5 years of growth are going to be as you think they should be.
And Nick, when you were going through this, share a little bit real quick. We got a couple around the process here, but I'd be interested, just did you get your feelings hurt? Did the clause come? I mean, you hear these stories of entrepreneurs and franchisors going through that, but what was your personal experience with this? And did you, obviously you worked with John and John helped you through the process, but just kind of give your real life experience when it came to the valuation of your business.
Yeah, well, I mean, I think in the early years before we had positive cash flow and positive EBITDA, and it's probably typical, entrepreneurs tend to value their business more for themselves than perhaps the outside market might value it on paper, because quite frankly, we know how much blood, sweat, and tears we've put into it, how much heavy lifting we've got the most conviction in our vision and so forth. when it came time for us to prepare our business to go to market to raise capital with most likely a private equity investor, we in talking to investment banks and getting sort of a gauge on where they thought we might fall based on the market, that helped at least set some expectations for us. But in running the process, we got offers, kind of where we would ask for groups to provide their bids, and then you could plot them on a chart, and they were kind of all over the place. You might see the bulk around like a certain part of the graph, but then you see some outliers way off, in the distance that maybe were valuing us more than others, but they might put some more teeth in the agreement that we weren't too keen on. Maybe it felt more like a majority or control investment disguised as a non-control or minority investment. And then there were some that were way undervaluing us, and those are the ones you tell them, to lose your phone number, don't call you again, because they're wasting our time. But no, it was an interesting exercise to go through. And John kind of hit the high points that we tried to focus on emphasizing when we went to market, which was our existing cash flow, what we called white space or green space ahead of us, where we could sell more franchises beyond the ones we already had. Our existing franchisees could grow much more than they already have, and so we could show sort of that 5-year projection model. We also incorporated what I would call kind of the blue sky opportunities that you're sort of selling the big shiny vision. Beyond that, you might get some credit for, but if you haven't proven it yet, it doesn't exist, and so you may not get the full credit for those things. So in our case, we were saying, well, look, we could do long distance moving down the road, we could do storage solutions down the road. So these are the things that we could expand into, as we grow and mature. So there was some element of that as well to help kind of paint the overall picture of this being a viable and sound opportunity to invest in. But the other thing that I think is maybe worth mentioning is before you hit timeline here, is that look, the investors at this level are very sophisticated. They're not in the business of losing money, so they're going to vet the prospective investment pretty heavily with their diligence. They're going to do their research. They're going to interview franchisees, customers, employees, and the like, to try to make sure that it's a business that they feel confident and comfortable backing.
Yeah, and John, going back to you real quick, we've got a couple minutes here before we do have some questions in the chat box we want to get to for the two of you before we hit the top of the hour. But Nick, that's really interesting and your experience there. And so, John, like for the emerging brands that are paying attention here, or any franchise brand, where do you start? Like, for instance, obviously they could call you, right? That would be a good way to do it. But like, is there, how do you find a private equity firm, for one? Where do you start there? And then two, once you go through what Nick went through, what's the average timeline? I'm sure it varies, but like the expected timeline of how quickly, maybe, if you're trying to take chips off the table pretty quickly, like, could you do it quickly, right? And then we can kind of get into what to expect in the chat box, because there's some questions around that. But just maybe, where do you start? And then the average deal takes, how long to close?
Yeah, so real quickly, I know we're running against time, but I would say, first and foremost, be a student of business. The fact that you logged on to this webinar means that you're half the battle. You're being a student of business and just in listening to us. One of the great things that I told people about Nick and his partner Omar is that they were significant students of business. I mean, they active in YPO, they have mentors, they were active in the IFA. They talk to private equity groups and to investors and to investment banks years before contemplating a transaction. And I would encourage anybody to do that. Even if you're small, even if you're not ready to do a deal, even if you're thinking about doing a deal, 2, 3, 4, 5, 10 years down the road, be a student of business, network. There's no shortage of private equity groups that are covering the space and will be at the IFA convention and others. All of them will take your call. All of them will have coffee with you, or set 30 minutes aside to just get a sense for what their criteria is. And that kind of helps you kind of build reps in terms of being able to speak to the investor community around your business. And so one, I would encourage you guys, anybody to do that. Just be a student of business and network around the deal community. And then, in terms of the process, a deal typically from start to finish takes about 6 months. It can take 3 months, it can take a year, but just kind of from start to finish, if you run a formal process, kind of a 6-month window is probably what people should expect, and that's, call it 90 days to get to offers, and then negotiate those offers and diligence another 90 days. Some groups move quicker, some groups move slower, and I would say that groups are now being private equity groups are being very aggressive about proactively reaching out to franchisors to kind of have direct dialogue, which is great. But you want to make sure that you have some competitive tension, and that can also shorten a timeline of a deal as well.
Nice. Nick, one last comment. So 30 seconds, just in your experience for the people watching, what would you say is maybe the one or two things that you wish you had known going in that maybe you'd give advice to the people here? Like, was there one or two things that you wish you had known kind of going into the process?
Patience. I'm by nature an impatient individual, and so I think there's got to be sort of an urgency of effort and patience for results. There's an old saying I learned about that the deal has to die 3 times before you actually land on the one that you're looking for. So we experienced a little bit of that as well. So just being patient and trusting the process that it would land where we wanted it to. There's, I think, something called deal fatigue, where you can get a little bit sort of worn out of the process of these town hall meetings and the answering all the diligence questions, and then you're getting to negotiating the operating agreement, and it can feel it's a distraction from your main business, but it can feel very exhausting if you're somewhat new to it. And so I think just sort of being aware of that and knowing to be on the lookout for that would have been helpful.
Great. No, I appreciate you sharing that. We do want to get to one question in the chat box, guys, and then we'll need to wrap. But the question here is, and maybe you both could quickly just address it, is, as an emerging brand, what are the 2 or 3 things to do early on so that you're properly set up when it's appropriate time to sell to private equity? So if maybe you'd say that you've already kind of addressed this a little bit, but the top 2 to 3 things, like today, they get off this webinar, they have a team meeting with their leadership team. What are they implementing to get ready for when it's appropriate?
I think John hit. I mean, I think the standardized chart of accounts, to the degree that you can get that in place, not only is it going to make you more valuable and prepared to sell or to raise capital, but it's also actually going to make you more effective as a franchisor, because you can coach the franchisees by benchmarking their P&Ls with one another and have that sort of what we call radical transparency within the system. We don't care if they're running their wife's car through the business. We want that stuff below the line, but on the standard chart of accounts, we want that stuff all consistent, apples to apples comparison. And then I think having that 5-year forecast of what the business is going to look like, and then measure against that each month. And if it has to be adjusted, we're in a different economic climate this year than we were, a year or 2 years ago. So sometimes the 5-year plan may have to get recasted, but having that long-term vision that then you can work back to the present to execute on, I think are two critical pieces.
Yeah, and just to build on that. Yeah, I mean, just to build on that, I mean, Nick hit it square in the head. I would say just anything you can do to invest in the data capabilities of your business, because people who are going to value your business really rely heavily on data, and so having just data components, little metrics, KPIs, things around the product or service mix of your franchisees, just things like that can just give greater visibility into the performance of your system is going to be really important. And then again, I would encourage everybody just to be a student of the deal world and reach out to people, connect at conferences. I mean, that's one of the things that I love about franchising is just because it's a business model and not specific to one industry. So many people are willing to offer advice, be mentors, provide guidance, and just kind of be a Sherpa for you. And so I would suggest to everybody to reach out to folks that have done this before or folks that are in this that are in the deal world. We're all happy to talk to you.
That's great. And John and Nick, I just want to say thank you, obviously, for jumping on and letting us pick your brain on such a important topic. And for the IFA, thank you for allowing our team at Thrive to sponsor this event. Very exciting conference coming up in a couple of weeks in Vegas. Hopefully, a lot of people that logged in here will be there. But we'll go ahead and wrap the webinar today. I think you'll be able to find it, right, Cindy, on franchise.org, the page that where they have the webinars. And it's also going to be on the IFA's YouTube page, which is great. There's a lot of other videos like this in the past that you can go in, like John said, and be a student of the industry and of the business. But thank you again for allowing Thrive to sponsor. Hope this was helpful. You guys have a great day.
Yeah, thank you, Matt. And yeah, you kind of covered everything. So thank you guys for joining us, and thank you, Matt, John, and Nick, for your time. And yeah, hopefully we see all of you guys in Vegas in about 9 days.
Thanks, guys.
Thanks, Cindy.